When you read a headline which says home sales in India's top 8 cities touch a 9-year high in the first 6 months of 2022, it's a reason to breathe easy. After all, the residential sector makes up for 75% of India's real estate pie, and it seems to be on a strong footing after a prolonged period of slowdown. Now, today on the show, we take a stock of housing sales, prices and new supply across top cities of India, which is 8, and ask the experts, how long will this upbeat momentum last? Also, is it time to pick up residential property as an investment and not just a home to live in? Joining me on the show are Sanjay Dutt. He is the head of Tata Realty and Infrastructure. We also have with us Gulam Zia from Knight Frank India, and of course we have Amit Bhagat with us, who joins us from ASK. I'm going to go first across to Gulam. Gulam, the numbers are looking solid. It's your report. 9-year high, 1.58 lakh units during the first half of calendar year 2022. Now, that's a 60% jump from last year's first half and also unbeaten since 2013 for any first 6 months. So my simple question is it reason to celebrate, or are we doing it too soon?
I would say it's a bit too soon to celebrate, because in spite of all the signs of a complete turnaround, how long will the party last is a question which I'm sure we'll discuss in the next part of your program today. But then there are signals around the corner which are, whether talk about rising interest rates or a lot of these things which are giving us some concerns that whatever has happened in last year and a half, while it is a bit too soon, because you normally follow a property cycle, and a property cycle goes for at least 7 to 8 years, if not at least 10 years. So next 3 to 4 years, there should not be reason to worry, but then we need to be cautious.
All right, that's a cautious note. Sanjay Dutt, I'm going to come to you. Also, these sales come on the back of, let's say, lots of SOPs from the state governments. There was a circle rate rebate in Mumbai. The MMR market has done phenomenally well. It's been the #1 market in terms of sales. You also had a circle rate rebate in Delhi happening. And now, of course, all of those things are changing. Interest rates on home loans were at their lowest ever, historical low in 40 years. That cycle is turning. And you also have an economic uncertainty, which we are all staring at. So would you say, let's get cautious before we say, oh, we are on a secular up move cycle of residential real estate?
Manisha, it makes sense to be cautious at this stage. I think it's a little early. The indicators that you mentioned are important, but the biggest indicator for revival in any sector are the job confidence in the market. When the jobs are good, customers have the confidence to be able to afford and pay the EMIs to the bank, and therefore, having experienced COVID recently and the uncertainty requirement for a home which gives wellness and a sense of security, overall the demand is good. I mean, look at the data. Last year we had 50 to 70,000 units more sold compared to the previous year. And this year also the initial indications are that we will do 320,000 to 340,000 units, despite the global concerns. And on global concerns, Manisha, let me also bring one more aspect. Back in global financial crisis, we did see disruption. And yes, India was also impacted for a short period of time. But when the crisis comes, corporations want to cut costs. They want to outsource more. They want to make sure that they have higher productivity. And eventually more jobs come to India, more outsourcing happens. And therefore the upside to the downside leads to more job creation and therefore benefit for the housing sector. Lastly, dollar-rupee relationship plays a very important role. The government recently announced that any relative of yours can now transfer 10 lakh rupees without question asked. So that's a strategy to increase foreign exchange reserve. But also the fact that the dollar has become strong, it makes India as a more attractive market. There were many private equity deals, Manisha, which were happening recently. And guess what? They've already gained as a result of it.
Okay.
So India has some very key strategic advantages, yet we need to be conservative and very calculative in our approach. And Gulam mentioned whether the party is over or not. But how messy the party is, it depends on that. If developers start celebrating too much and start increasing beyond the justifiable increase, because justifiable increase is because the cost has gone up, Manisha. So it has to be paid for. So I think developers are conscious. They will take the benefit of the upside, but we are treading very carefully still.
All right. Amit Bhagat, so we talked about private equity money, of course, institutional money which is flowing from international shores. It works for them to bring in money in dollars because they get just more value in rupees. But domestic funds is yours. What's your view? Are you going to raise more money and invest more money in residential? Because if I'm looking at the overall pie, most of institutional money is still going into commercial assets and not really residential. It's still a very small pie.
So I think all institutional investors who invest in commercial reality do that because they are not willing to take a development risk. And most of the institutional investors outside the country in developed markets only invest in commercial reality because of the yield which they get, the rental yield. And hence only domestic funds are left for the residential play. But as liquidity improves, and India is a very attractive destination for residential because we are the only market which is a user-driven market. So if you go to markets like say Dubai, London, New York, foreigners can invest. But in India, only users buy. There is no tax incentive for buying a second home. So India is a very attractive end user-driven market. And I think that is the reason I am very, very bullish on sustained momentum for the residential sector.
So will you be deploying more money, Amit?
Yes, we are raising more money. We are deploying money as we speak. And I think we are very bullish on the residential market because of the end user demand.
Gulam, coming back to the price rises. Now, overall prices, as I see, have risen only between 3 and 9%. Bengaluru is an outlier there with 9% increases. And of course, some of the markets have been just very slow with price increases of 3%, which does not even actually map up to what the inflation has been. Now, are these averages? Good developers, I believe, have been able to raise better or maybe 10 to 12 or 15%. Is that correct in my understanding? How do you see price rises going forward? I mean, Sanjay has already warned that developers have to be very careful before raising prices. We already have news of layoffs beginning to come up.
Well, first of all, the point that you explained is bang on. The increase that we are talking about, that we are referring to, are weighted averages. So while, say, if you're talking about 9% in a certain market, there would be a few developers who would not even be able to get a percentage or two of a rise from the consumers. On the other side, some renowned developers, a few of the A-grade listed players may actually get away with 12 to 15% increase in the same market at the same time. So what we are referring to are weighted average price rises, and it is evident that a few of these renowned developers have actually increased the prices in a few key projects where the products are superlative or good to even 12 to 13% as well. So absolutely right, the point you made that these are weighted average price rises, and we need to be cautious while we are out there in the market and understand how each project is individually performing. But going forward, the concerns do remain. As Sanjay mentioned, that if like we have seen the history, the performances earlier is very clear that the developers in their celebratory mode start taking prices so high that the affordability goes out of the window, and that is where the things start falling apart. So forward looking, at least we see that the prices shall remain very, very stable going forward, and still not really giving you enough of reason to expect 8 to 10% rise every year on year. The markets are not yet in that place to talk about 8 to 10% year on year price rise.
Wow. So you're saying you may not even get 8 to 10% hikes going forward, probably a little bit more tepid. Sanjay, you spoke about how for institutional investors it makes a lot of sense to bring money in dollars and invest in Indian real estate. What about NRIs? You know, this is a twin-edged sword. You bring, of course, dollars, they can buy you more today in rupee, but when you have to take it back, and a lot of them also do wish to sell their real estate after 8 to 10 years and have that option of repatriating, it's not good news. I mean, dollar adjusted or rupee depreciation adjusted, your returns literally either are just nowhere or negative. So for NRIs, how's this market?
Manisha, you are right. When you take the money out, you take a hit. But there was a time for a decade when the arbitrage was at disadvantage. Today, we are at an advantage. And the reason I say that is, if you look at the inventory point data, you see we've not touched so far in our program that the inventory used to be 40 months. Today, it is 15 months inventory to 20 months max in some cases. And it is fast coming down. Second data point is in NCR and Mumbai, in prime locations, the rental values have gone up. Now, as a result of this, what has happened, it has made the markets attractive for the investors to come in. And a lot of road shows, Dubai property shows and overseas shows have started to result in good volumes for developers. So these are very good signs, which perhaps for last decade was missing. Investors were not keen because the prices in residential had not gone up. But now that the prices are going up and they're likely to go up even more, at least for a period when the supply doesn't catch up to the demand. And there's one more angle, Manisha. You know, in one of my statements a few months ago, I said the inventory has come down, but so has the inventory of the developers. So there are not many institutional developers who've been able to unlock opportunities in the market. Right. Now, I was speaking to Irfan from Swami, who's also shared with me a very positive news that the price increase in some cases has gone up to 20-25%. So all Swami-backed projects are doing extremely well, actually, and that's good news. But still, 3 lakh to 4 lakh crore worth of projects are stuck, Manisha, and they may not be able to come to market at least for some period of time. And you know, real estate takes time to develop. So there is a 3-year lead period. So by the time new projects get launched, it will be a while before the supply actually reaches a point where the cause of concern or prices not going up, etc., may start, worrying the developers. But so far, there is a 2-year run, in my opinion, which is quite promising. Except, of course, we need to see the cost of capital doesn't go up and cost of construction doesn't go up. If they get disturbed, then the reset has to happen in the real estate again.
All right. So for all our viewers, Swami Fund is the fund which has been set up under the aegis of the Government of India to complete incomplete projects or projects which have been stuck for a long time. But of course, now there is some room to revive them, complete them, and also get some returns out of them. Projects which are dud are, of course, not being touched by the government. Stay with us. We'll come back and delve a little bit deeper into what Sanjay said. Real estate is also considered to be a strong hedge against inflation, but with rental yields on residential real estate, I'm not so sure how much have they gone up, because according to me, they're still around the 3% range in India, and that's still not compelling enough unless you get capital appreciation or you expect the property prices to go up dramatically. So, should you look at real estate as an investment option now that the stock markets are not doing very well? Stay with us. On the other side, that's what we'll have for you. Data released by Knight Frank India shows that the country has clocked the highest housing sales in the last 9 years in top 8 cities in the first half of 2022. Now, most experts are predicting the strong revival of residential property cycle will continue for some time. The question we are asking is that stock markets, currency markets, commodity markets are all looking weak. Now, should you look at buying another residential property as an investment? Amit Bhagat, Sanjay Dutt has made his view very clear that there are pockets you might get extraordinary returns in, and investors have returned because India is a slightly different market than the rest of the world. What's your view on this? My question is that if your rental yields are only 2 to 3, maximum 3.5%, unless you can predict a really strong capital appreciation or property prices going up, this is a risky bet.
I agree with you, Manisha. Rental yields are 2 to 3%. Plus, please understand that if you buy a under construction property, you pay 5% GST, 6% stamp duty. So on day one, you are negative by 11%. And your cost of fund, which is a home loan rate, is 7.5 to 8%. Your rental yield is 2 to 3%, and there is no tax benefit for a second home. It does not make any sense to buy residential property, especially apartments in top 7-8 cities as an investment. What you can look at is plots and agriculture land. But that also, it is a cyclical business. So if somebody bought in 2020 when prices were down by 20-30%, then it makes sense. Otherwise, my advice to all the investors is this is not an asset class you should look at because of negative NAV 11% on day one, cost of fund at 8%, and rental yield of 2 to 3%.
So, Gulam, it seems only private equity investors like ASK Property Fund make money when it comes to residential, not the Aam Aadmi. Just a very quick question though, even when I'm buying real estate for my personal use, right, I do want to see a capital appreciation going forward. Looking at the math, the demand, the supply and the price rise, and where you think job creation will be the highest, which are the cities which are looking good in terms of where price appreciation could be higher?
Well, first of all, a quick one on your point that we started from when, an individual vis-a-vis a fund. A fund is obviously investing in a under construction property. So their risk of development side, marketing side is all coming to their rescue. And that's what they're making their profits out of. But an end user is buying a built property. And the built properties are not going to be changing as fast. Like as we spoke a short while back, I mentioned that 5 to 6% per annum kind of property price rise is not something which is making it a lucrative asset class for investors to jump onto. Because otherwise, as even Amit mentioned, you are entering negative. While Sanjay Dutt wanted to make a point, I'm sure he will. But which is what it is. As an end user, I will have to look at all that. And now coming to your second part about which cities. Well, in last 5 to 6 years, Hyderabad is the only city where we have seen steady and consecutive price rises every year after year. That apart, none of the cities have had that kind of a performance. And even going forward, we are not expecting none of these cities to change that trend. 5-7% of a price rise, which is even lesser than the inflation, is what anybody would think of. Because nothing else is changing in the market. I can see Sanjay smiling, and I'm sure he'll have a lot to say against that point.
All right. So we have only a minute left. Let us get in Sanjay and Sanjay. So here are two contrarian opinions which say, don't worry about where stock markets are going. Please don't jump into residential real estate thinking it's going to be a great investment because everybody's saying so.
Amit and Gulam are causing potential 8 to 10% loss to all investors in real estate. First of all, there is a 2% yield. In the past, there was no capital appreciation, so it was not sensible. But if there is a capital appreciation on an annual basis, even on conservative basis of 2%, you're in 4% play. And my view is that it will actually be 5%. Also, the cost of capital, the interest rate regime in India is moving downward. I don't think the cost will go up. So it's very likely that in not so distant future, we will actually have a positive spread between cost of capital and capital appreciation and rental yields.
Right.
So if you look at all global markets, that's where they are, and we will be headed in that direction.
Okay.
Secondly, Manisha,
Sanjay?
very quickly, if you want to create wealth in India for a salaried class employee who knows that he can pay the EMI timely on monthly basis, can create an asset. And they don't worry about 2% or 3%. They worry about, in my old age,
On
will I be
safety.
able to
Sanjay,
afford
unfortunately, I have completely run out of time, but I think we got your point that, it is a great saving way or forced saving for a middle class family, and a stable and steady one at that. Thank you, gentlemen, for joining me. And we can just keep our fingers crossed that, all of these things like rising interest rate, inflation, economic slowdown don't play a spoil sport in this housing market revival, because there are tons of youngsters who still need to buy their very first home. Thanks for joining me.